a couple of things that you want to keep in mind preparing for your audit. One, you want to have your books in order. You want to make sure when you have an accounting system and that's all set up and you're doing your bank reconciliations on a monthly basis, that you know what's in all of your accounts. The auditors are going to come in and they're going to want to see reconciliations of your bank accounts, of any other accounts, if you've got accounts receivable, if you have some liability accounts, if you have prepaids. They're going to want to see that you're reconciling those accounts, that you know what's in them, that you know how much money you owe and what vendors you owe, and who owes you money is also another very important thing to keep track of. But you'll also want to make sure that you have any grant agreements that you have. You want to make sure you have those grant agreements, the actual documents, you have the budgets that go along with them, and that you are personally tracking, or someone within your organization is tracking how you're using those funds that were given to you by the grantors, that you have, hopefully that's in your accounting system, that you're tracking it there. But even if it's in Excel, to say exactly what those funds were spent on and how they specifically benefit the program that they were given for. So you want to be able to make sure that that you have that tracking in place, that you can show exactly how you spent the funds that were given to you for the purpose that they were given to you for. That's huge for the auditors. Also, policies and procedures. So, they always like to see a policy and procedures manual that documents kind of how you're doing, what you're doing. But even if you don't have it documented in a specific policy, that you have written down what those procedures are, especially around the finances. Who's responsible for doing those reconciliations? Who's responsible for, depositing funds in the bank? And taking those monies to the bank, reporting them into your accounting system, and how those processes are done, and what oversight is in place for those functions. Because we always want to make sure, one of the important things for nonprofits and for all organizations is that we have appropriate segregation of duties, so that we can show that if someone is recording the transaction, somebody else has oversight and is reviewing to make sure that those transactions are appropriate. So you don't want to just have one person in the organization responsible for everything that goes on. Particular ones that you want to have in place, like around cash, you want to make sure somebody's reviewing the bank activity daily. That's an important thing. And sometimes we think, well, we're doing the bank reconciliation on a monthly basis. Well, if you're only looking at your cash account on a monthly basis, something could happen on the 1st and you don't catch it till the 30th. So really having eyes on that bank account on a daily basis, just to see what's going through, because there's a lot of people out there who are trying to get access to somebody else's cash. So lots of times somebody might be pinging your account, you might be seeing some small transactions. And if you let that go, then they might try something larger. And if you don't catch it in time, then the bank might say, well, you didn't give us proper notice. So you really want to make sure somebody has eyes on that. If you have payroll, so you want to make sure that as the executive director of that organization, that you are looking at those payroll reports as they're going through, making sure that the people who are getting paid what they should get paid, and whoever's processing payroll for you is not putting something through that shouldn't be through. And I always say, coming from an internal audit background, internal controls in an organization are really put there, one, to protect the organization, but also to protect the individual. So you should never feel like if you're putting controls in place that is kind of limiting what someone in your organization has the ability to do. You just want to explain to them, like, this protects you as much as it protects me, because if somebody has too much access to your cash, you never know what might go on with them, but then you don't have to have a concern that something might happen if there's a second level of review on what's going on. This is the slide that just talks about policies and procedures, mostly over cash management. I think we went over pretty much all of these. And then the segregation of duties. So really here, this is really looking at where we want to, things that need to get done, that maybe some things can be done by accounting staff, some things can be done by other staff in the organization, some things that might be done by management. Sometimes you can pull a board member into your process if you really don't have that many. staff within the organization to be able to properly segregate things. So the one just example here that's highlighted in the orange boxes is reconciling the bank statements, preparing checks, and then signing checks. You really want those to be 3 separate people, but obviously in a very small organization, that's really difficult to do. So, whoever is actually preparing the checks, writing the checks out of the system, shouldn't be the same person who's signing them. Realistically, that could actually be done by a board member who has check signing authority on your account, or approving them if you're using electronic payments, which we definitely suggest. And then the person who's reconciling that bank statement should really be outside of the process of actually preparing the checks or even doing the deposits, processing any payments of any kind. So, to the extent that you can have kind of a separate independent party who's doing those bank reconciliations outside of that accounting process, that would be really helpful for the organization. A lot of times you can't do that. So what you might do is, even if the person who is actually preparing the checks is preparing that bank reconciliation, then you want somebody above that person, executive director, treasurer on your board, to review those bank reconciliations. So it's, kind of what we call a detective control versus a preventive control. So detective is kind of happens after the fact. Somebody's kind of looking over the shoulder of the person who's doing that reconciliation, not actually, not literally, but is able to review that reconciliation once it's done, make sure it ties back to the bank statement and everything is appropriate there, so that it can give you some additional level of comfort. So building those types of controls or additional procedures, depending upon who you have available within the organization, would be helpful. So just recognizing that it's not always perfect, but kind of building in that oversight will help the organization as well. Any other thoughts on that one?
Any questions, folks who are trying to set this up?
I do have here just kind of some information on bank reconciliations and just the importance of doing bank reconciliations. Again, this will not take over for reviewing that bank account information on a daily basis. Really, we really do recommend that somebody has eyes on your bank account and the activity in there on a daily basis. If you're using QuickBooks, you can connect it to your bank account and pull in that activity, and you can just view it in there, or just going online. You can set up things within your bank account so that it tells you, when there's activity. If you don't have too much activity on there, it can just tell you when you have activity. It can tell you when you have activity over a certain dollar amount. But again, just making sure that somebody has eyes on that is really important. One other tip, and this is really just kind of from a fraud perspective, and probably not so much an issue for you because you're probably tightly controlling those bank accounts for you, but just making sure that anytime anybody is asking for a change of information, you get a vendor that sends you an email and says, hey, send it to this address instead of this address, or put it into this bank account. Just pick up the phone and call them. Just don't rely on the email. There's so many phishing emails and things like that come out constantly, that people are just trying to get you, they're trying to get access to your money, quite frankly. And you want to protect your organization from that. So I can go on with the slides from here if you'd like.
Please, yes.
Okay. All righty. So
if you have a question, just type in the chat.
Okay. So this slide and the next slide really just talks about responsibilities of the board. Every nonprofit organization should have a board in place, and there are specific responsibilities that the board needs to be aware of, that they need to make sure that they are covering for the organization. So there's basically 3 duties. They have the duty of care, which means that they're going to participate in active oversight of the organization. There's the duty of loyalty, which basically means that they need to put the responsibilities of the organization above themselves. So if they're serving as a board member for the organization, and there's some potential conflict of interest, they need to put the needs of the organization above their own needs with regard to that particular situation. It's important for them to understand that. And then there's the duty of obedience, which really, requires that they show up as a board member, and that they are actively looking to make sure that they themselves and the organization comply with applicable laws and regulations and act in accordance with its own policies. And then looking specifically at some financial responsibilities of board, there's basically 3 committees on a board that have financial responsibilities. The first is the finance committee. And of course, best practice here would be that there would be 3 separate committees. In practice, many nonprofits have one committee that covers all of this, or it might be an ad hoc thing with the audit and the investment committees, but absolutely as a minimum must have a finance committee for the organization. That committee should be reviewing the financial statements of the organization, because they're basically there to provide oversight and guidance of the finances of the organization. They're also going to assist in budgeting and financial planning, and then creating and monitoring the financial policies and procedures. So always within this finance committee, you want to have someone on that committee who has a finance, accounting, auditing background, someone who can read and understand your financial statements and really give some insight into the organization on what best practices are from a finance perspective. Your audit committee, again, this can be an ad hoc committee or it can be a component of your finance committee. They're going to be responsible for the accountability for the independent audit. They're actually the ones who are supposed to engage the external auditors. It should not be management. It really should be the audit committee. Management kind of shepherds that process, but the audit committee should be reviewing that, approving the auditors, and reviewing the audit reports when they come through and having those meetings with the auditors. Lastly is the investment committee. And if your organization is blessed enough to have separate investments, then you definitely want to have some folks on your board who have information, who have insight. Maybe they've worked in that field before, but can give you some guidance on what type of investments the organization should have, and be able to monitor the policies, but also the investment results of the organization. All right, so different types of financial reports. So on the left is kind of what we call our baseline, and those are financial statements that every organization should have essentially every month to look at. So there's a balance sheet. Nonprofits, it's called a statement of financial position, but it's basically the same as what you would see in a for-profit. It basically just goes through kind of what you own, all your assets, your cash, your investments, your receivables, compared against what you owe. So any liabilities that you have outstanding. And then the difference between that is basically your net assets in a nonprofit organization, which is very similar to your retained earnings in a for-profit entity. So you always want to be able to look at your balance sheet as of a particular point in time, and then also your income statement, which again, for nonprofits, it's called a statement of activities. And that's basically just looking at the revenue that you earned versus your expenses that you had to pay out for the organization. So those are the 2 basics. A cash flow statement, which everyone says is very complicated, I think, and a little hard to understand, but basically the cash flow is showing you where your money went, kind of where it came from and where it went to. So I think it's important for organizations to understand, and I guess that's one thing that I probably didn't go over, is the difference between cash basis and accrual basis of accounting, which is very important. And we always tell our clients that you should be on an accrual basis of accounting, because it really helps you to understand kind of month to month what goes on within the organization and be able to benchmark prior periods. So if you're keeping your books on a cash basis, that means that you're only recording things when the cash comes in or the cash goes out. So you're not really keeping track of how much people owe you or how much you owe other people. Accrual basis is basically the direct opposite. You want to set up those accruals and you want to set up your receivables so that you know what you're expecting to come in. And then from a forecasting perspective, you can forecast out when you expect those things to come in. So cash flow we do think is very important. Looking at a variance analysis. So if you're looking at your income statement, you always want to be able to compare it to a budget that you've prepared, what you expect to happen for the year, compare it to the prior period, to the prior year, but giving yourselves the ability to say, okay, this is what happened this month. Is that a good thing or a bad thing? So either comparing it to your budget, what you expected to happen, or kind of what happened in a prior period to know, are you doing well or not? So those are kind of the basics. Other things that you might include in your financials are a memo, just kind of telling the story, some additional reports. You might have departmental reports or program reports. Budget variance analyses by department or by program, I think are very helpful tools for the organization to really understand if you have multiple programs within your organization, how each one is doing. You want to know, overall the organization might be doing great, but you might have one program that's really losing money, or you're not getting revenue in, or you're spending too much on that program. And in order to make change, you need to know what's going on in each program separately. Your accounts receivable, accounts payable detail, I think you want to keep track of that as well. And then forecasting, I think, is really very important. That's the last column there, to be able to project out where you think you're going to end the year or where your cash is going to be at the end of each month, so that you know how the organization is doing and where you'll be in the future.